Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. Guys, even though we have bearish indications in the economy that a recession may be creeping up on us, we have probably the best trade of the decade setting up. You're not going to want to miss this video. Let's dive in.
Trade Genius.
Hey guys, really briefly before we jump into this video, appreciate all the likes and subscribes, and if you can ring that notification button, that really helps us out. In addition to that, if you guys don't mind, head over to tradegenius.co, check out our specials we have over there. There's a number of different specials with different packages for all different experience types. If you're more into education, we have a package for that. If you just like to get into the room, primarily, we have a package for that as well, where you can see where we're calling out trades and things like that live, and also posting signals into our Discord signal rooms. So check it out, tradegenius.co. Appreciate you doing that. So Bob, before we get into like this trade, which I think is really awesome setup here, we got some economic data that kind of continues down with the theme we've been talking about over the last several weeks.
Yeah, we've been trying to explain to you guys that basically this is pure physics and we have no choice. We're going into a recession. And this chart I want to throw you up here, and shout out to this guy at Steve Anastow. So we're stealing his chart here, but it's a great chart. And from the Bureau of Economic Analysis that basically shows that there's two components and they have to equal each other. I learned that Econ 101. The gross domestic income must match the gross domestic product. And you get these short-term separations from each other. And we have one forming right now where the income is collapsing and the gross domestic product will follow along. So it's going, we told you guys yesterday that, a lot of the good guys for the GDP is gone, and this thing is heading now towards Zeroville. And I couldn't believe this, Phil. They said it's going to be 3.5% in the next quarter GDP after inflation. So they're calling for what, 4.5% growth in GDP, with,
right,
including inflation. They're out of their gourds. GDI is telling us something totally different. And I think once people truly recognize that, there's going to be an awesome change in psychology. And this next chart I want to show you is that divergence. This is the S&P 500 and a 30-year treasury yield, okay? Total return, okay? You notice they go hand in hand here. But when you get these, we call these alligator jaws moves here, they snap back together, they converge. And we have one of these divergences now that are going to converge back together again. So one of two things is going to happen, right? Either the 30-year yield return, that's not interest rate, that is total return, that's principal and interest. Either that goes off the rails, right? And then the stock market crashes to catch up with it, or you get a turn in the bond yields and the bond principal, which I think is the more likely trade, and it sets up for one of the best, most conservative trades out there. This is a trade I took in 2008 into 2009. TLT doubled, which is a 20-year ETF. It doubled over a 9-month period of time. And you didn't have to worry about anything. You just sat back. And there's a trigger for this, Phil. And the trigger is when the Fed pauses on the second meeting that they don't raise interest rates, TLT will take off and the stock market will go down. And that's where we're at that point right now, Phil.
Yeah, these are some pretty stark divergences. And even if the returns climbed on the 30-year, you still have this big catch down effect with the S&P 500. I think the GDP chart that we showed there, maybe we can flick back to that real quick. I mean, that is the largest divergence we've seen, GDI leading down with the GDP. So, but this is probably the 15th chart we've shown that when you get down to these levels, it's recession. And I just think that you have to okay, that's the writing on the wall. If we avoid it, it would be a miracle at this point. So then it's like, okay, now you have these things like the bond chart here telling you what's up in the bonds and the inverted. I think people are falling asleep at the wheel with the yield curve inversion. Either A, they're not paying attention to it because I don't see a ton of chatter about it, or B, they just figure it's one of those times where the yield curve is going to be inverted and that's okay. And I just don't think that's the case because too many things with the data about the economy are coming to a crawl or a stall.
Phil, you were right in March. Do you remember when you had your little Twitter tiff with Martina Booth when she was telling you that what the Fed was doing was not was not a liquidity driven and basically a QE event. Remember
Right.
that?
Right.
Oh, it's not going anywhere. Well, now you have articles all over the place that said basically it was a stealth Fed pivot
Right.
when
Right.
they rescued the banks. Well, that just unwound now too. So all the tailwinds, and I think that's what kept the market going. Everybody was sitting there with fans, trying to get the charcoal briquettes going here just to keep this thing moving along. But that has now zeroed out as well. And this is the other thing that's blew me away here, this next chart. And this is why I'm like, okay, when people lean so hard, a couple weeks ago, we told you guys oil was going to go to $90. It was sitting at $68. And it's because of the bearish bets. In January, we had bearish bets in the stock market. What'd they do? They squeezed them. They had bearish bets in the oil market. What did they do? They squeezed them. And we're about halfway through the oil thing. We crossed over 80, by the way. And I think once we get to 85 area, it's going to be the last $5. Will probably be a big grind. But if oil rolls over, it's because the stock market's rolling over. But now here's the next big bet. Everybody's bearish on bonds. So, when people say, oh, they're not believing that the Fed's going to not raise rates. Well, here, they were voting with their pocketbooks. They kept shorting. And they've been getting paid, Phil, okay? Because the 10-year crossed over 4% briefly on Thursday. And so we're going to get to the point now where somebody's going to reverse this bet. And I think it's going to be our good friends, the Japanese, because they're going to have to, as they continue to push yen into the marketplace, they have to buy higher yields. What a great game if you can get it. You can conjure money out of thin air, Phil, and then buy a bond that pays you a coupon. We would go to jail for that. And it's called Central Banking 101. And I think there's going to be, I think once China is done selling treasuries, they have to. It's not geopolitical. It's actually survival on their part. When they run out of treasuries, then this thing's going to turn so hard, it's going to make your head spin. And the U.S. has no choice, Phil, but to do yield curve control here at some point, because we're already spending over 6% of GDP in debt. Okay. And we're close to $1 trillion now of interest payments. Unsustainable. I don't care what you say. So it's a binary trade. If they do nothing, you want to buy everything that's precious. Right. Crypto, gold, silver, platinum, palladium, farmland. Right. And if they put yield curve control on, you want to buy this trade right here. You want to buy TLT and hold on to it for 2 years. You're going to get a double. And you're not going to have to do any work whatsoever.
Yeah, I was going to say TLT, you could even see more downside initially because I think there's a chance we get a new high on yields. So this isn't like, if it goes down next month or something like that, don't think like the call was wrong. Bob's talking about layering in at these levels because, this is going to mean revert. You're going to have this basically all of this. This is positioning here. So this is how many people are betting to the downside. And you're going to eventually get an unwind because this is like everything else in the markets. Too many people are on the wrong side of the boat capsizes. And you see that during hedging events, if you're going into, say, an election and everyone's hedging to the downside, that unwind creates a big rally. That's why sometimes post-election, you see these big sharp spikes. People are unwinding their hedges. Same thing's going to happen here. Even though we could go down a little bit more in bonds, TLT could maybe go down a little bit more. I think Bob's completely correct here. And then over the course of the next 12 to 24 months, you're going to see that thing just moon. So it's not something that people, Bob, a lot of people don't understand how to buy bonds. So what is, like, for the retail guys, what is the easiest thing to do?
Yeah, so the easiest trade to do is, so I would, over the next 30 to 60 days, I would layer into TLT. Okay. I like that one. And so remember, it'll probably double bottom around $88 to $90. All right. It pays a coupon, so it pays a monthly dividend. And then what I do with it, because I trade TLT and TBT all the time, TBT's its inverse, is that I sell calls against the position. So, you can get a nice 12% yield on TLT just on the coupon they give you for the divvy and by selling calls on it. And so that's the way, you can play it or you can scale in. But here's the deal. If it gets over 110, buy it. If it gets down to 88, buy it. In the meantime, just average in if that's the way you like to play the game. So this isn't a Monday market call, although this can happen at any time. But I'm pretty sure, we're going to get a September skip in the Fed meeting. But you have to wait. He has to skip and say they're done. Okay. You can't be this pause thing again because they're going to keep pressing on this. And then this is going to be the trade. trade. When we start going negative GDP, you want to be in this trade. You don't have to be in any equity, just be in this trade. It was an awesome trade in 2008. Look it up.
All right, guys. Well, let us know what you think. Do you like this bond idea trade against the equities if we go into a recession? Do you think we're going into a recession? Or did you even consider going long bonds? We'd love to hear your thoughts on this. And that's going to do it for this video. Guys, have a great weekend. Thanks for watching. Check out our specials over at tradegenius.co. And Bob, thank you so much for this video and these charts. And we'll see you guys on the next one. Take care.
Trade Genius.